What's up, everybody? Ted here with some Eyes and Wicks. Sorry I couldn't make it a lot earlier like I was supposed to, but had a lot of technical difficulties. Plus, I was basically addicted to the charts because there was a lot going on, and we'll get into those in just 1 second. Oh, there we go. I guess when you have the mute button on, it won't work. All right. All right. So, anyways, I was going to take a look back at the week. See, basically what we saw, a lot of increases, unexpected increases. Well, kind of unexpected, kind of expected. And then what we saw toward the end of the day today, that was interesting, and how it kind of reflected across almost all cryptos. So, if that were to happen again, how would you prepare for it? That kind of thing. So here we talk about smart money, what is smart money? A lot of people ask me. That is the practice of basically large institutions having control over the charts. They can push it whichever way they want. They know how you trade because you're taught to trade a specific way, so they know how to go against that, and at certain, I should say, price levels, and take your money, basically. That is what they're designed to do, because basically 90% of this market loses money. All markets lose money, not just this market, but 90% of all markets lose money. Only 10% gain money. And guess who those 10% are? Yeah, the big guys. So if you're not a profitable trader, don't worry, hang in there. I'm going to try to give you some tips and hints on how to be a profitable trader, because believe me, my first year I was horrible. I lost a lot of money, and then my second year I took a mentorship and started really understanding how the charts work, how smart money works, how these people control the charts, and then started making more trades toward the end of last year, the beginning of this year, and turning out to be more profitable than thought. So like I said, once you get into it, you just kind of have to think about putting yourself into another person's shoes who has more money than you, a lot more money than you, like billions of dollars more money than you, and then going from there. And then it all kind of makes sense, right? So if that's the kind of thing that you do like, what I would like you to do is hit that subscribe button, hit that like button. That would mean the world to me. It would also mean the world to this channel, or hit that rumble button, whichever one you're watching on, and let's get going. So let's check out. Okay, so first, earlier I was posting from the comfort of my couch, not from here, the trades that I was doing on Ethereum and what to expect. So earlier, it was probably right around in here. It was early this morning, 7 o'clock. After it formed this fair value gap, right, it came up, and I thought I said it was probably, well, I knew it was going to at least get down into here, and my guess was that it was going to get up into this box right here that I have where it says 5-minute gap fill. So we are on the 5 minutes, and if we go over here to where this peak is, you can see a little bit of a fair value gap. So fair value gap is whenever there is a wick on either side of a candle that does not touch. That leaves what's called an imbalance. I'm sure you guys have heard me say this before if you ever watched my content. If you never watched my content, this is new, right? This is primarily I picked this up with a mentorship that he usually does Forex. Right now, he's doing a free mentorship online with the New York indices, or the U.S. indices. He goes by Inner Circle Trader, but I went through the private mentorship with him, so I got a lot of insider knowledge, things like that. A lot of videos, a lot of homework, a lot of different stuff. So I took that to the crypto world. He does not like crypto. I took it to the crypto world because I wanted to see if it worked, and it does. So not only is this algorithm that he speaks of alive and well in the crypto world, it's also alive and well in every other aspect of every market. So what happened was that okay, so I broke it down to the 5 minute. A lot of people don't even like getting down to the 5 minute. But if you are a high leverage trader, and you just want something quick in and out, something that you can, make, a little bit for the day and just be done with it. It's kind of the way for you is kind of a quick 20 times leverage trade, 15 leverage trade, something like that, and that's what I was trying to get at, basically, because once this gap formed, I believe I said that it should come down and fill the rest of this gap, right? And then once it did that, then we should see it rise up and actually attack this gap here, because that's what price does. He said this yesterday on his last mentorship video that's on YouTube. He said that price does three things. He says it attacks liquidity, and it attacks imbalance, and it also depends on time of day. Well, time of day can be a little bit iffy with crypto because it's a little hard to it's a little bit harder to understand than, say, the foreign exchange market and or the indices market. Because the foreign exchange market, for one, is just depends on what time of day those areas are baking at that time, right? So if it's the pound versus the dollar, let's say, it's going to be more active right when the dollar opens, let's say, but it's also going to be very active whenever the European market opens, or the London Stock Exchange opens, because that's when everything starts moving. But then it overlaps with, sorry, I didn't mean to hit that. But then it overlaps with the U.S. market at, coming in at 9:30 a.m. New York time. So then you'll see more volatility coming in then. But there's things you look for in between that point, those 2 points, to kind of base your bias and understand where the price could be going to. So that's what I did here, basically. It was 7 in the morning on a Sunday. Not like there's a whole lot of banks open, but there are institutions. There are institutions that are, I wouldn't say they probably do have at least a 51% majority of ownership over most of these coins, which means that they would basically be able to control how the chart flows. So here we had a little bit of a gap, and then it pulls back down into it. Okay, that's what we call you know what, I can't even think of the term right now, but there's a specific term for it. It's been so long that I've watched any of his videos, but basically it's almost like an entrance. And I think of it as two different magnets, right? So you have a magnet that is attracting one, right? And that's what that's doing here. It's the box, or the imbalance is that magnet that's attracting the price, right? And then once it gets into that area, then it's more like a like when you flip the magnets over and they repel each other. That's what kind of happens. So it does that, repels, comes up. Now what it does is it actually does a huge, no, I wouldn't say huge, but it leaves a very, very large wick at the very top, which breaks the top of this high. Now the reason it would do that is because anybody that is seeing what is this in this area is seeing that, okay, this could possibly be an area to call short, right? So that would be, your sell limit area or your resistance. So this could have easily poked through if somebody was having a sell limit, let's just say right here. But let's just say they didn't have this big of a stop loss, because a lot of people usually don't. They usually like to put them very, very close. Maybe not even that close. Something like this. Because they think it won't get any higher than what this guy is doing here. So they usually put it maybe just a little bit behind that. And one of the ways to get around that actually is with a different indicator called the ATR, which I haven't put on here just yet. So I like using the ATR for that reason, in case you are one of those people that do try to short in an area that you're not supposed to. I say you're not supposed to because that's where smart money is going to be, and they're going to take it the other way. What you would do in this instance is, let's say it does get to that area, right? So if it does get to this area and you're looking at this, your ATR, or your average true range, is 433, or what does it say? Yeah, 433 is what it's telling me. So what you would do is that from the end of this point is then you would actually add 433 to it, or maybe even more than that. Short position, inputs, entry price 35.12, stop level 433, so be 46.99. All right. Now let's see. Now, it did it at first. It would have, well, let me move this. It would have blocked, or if it came up into that area, you would have been fine, right? But that would have been only that first time, right? So you would have been able to go short, right? And what a lot of people think of is that they think of it as going down all the way down to this bottom. Why? Because there's two equal lows, and that's what a lot of people expect. They expect it to go all the way down to this bottom. Well, if it is going to go all the way down to here, what it's going to do and I'll show you later, is it's going to go lower than that. The reason it's going to go lower than that is for the same reason. Everybody's expecting it to get to the same point. But instead, what smart money will do is they will drive it further down to take out people who are doing this exact same thing, just the opposite direction, right? So let's say you had a long call, and let's say you put it here, right? And let's just say you didn't really understand the concept all that well just yet, and you placed it here. And let's say you're just waiting for it, right? Well, first, what you want to do is you always want to look for imbalances, no matter what time frame. Any time frame can work, right? Even here there was an imbalance, and it came down into it, got rejected out really quick, and it hit another imbalance and then came back down. So this is a good example from one imbalance to another, right? Is this right here. I'm gonna get in on this really quick. So if there's one imbalance, we move it over, right? And let's just leave it there. All right, I'm gonna move this up, and actually I don't even think it gets to the imbalance. It may have just gotten short. But if it was me and I was trying to play imbalance to imbalance, however close it gets to it is fine with me. Okay, it looks like it didn't actually get into the imbalance. As close as it gets, I will take that trade and pull out and call it a day. Or no, I wouldn't say call it a day, but say call it a positive at least. You know, that's a good scalp. That right there took 10 minutes to develop, because it came down into a imbalance that we knew it would come down into, or that we expect at least. And let's say we somehow caught it right here, and we may have not caught it on the wick, but we may have caught it somewhere at the end of the body. I mean, it's $10 in Ethereum. You know, leverage trading, let's see here, if that's 0.3% leverage trading, that could have been 10% or something like that. That's not a bad trade for a scalp. Just saying. Okay, so now let's say it comes. We're talking about this imbalance now, right? So I said it would come down to this imbalance. I was expecting to come up into this. If you watch one of my shorts, I think is what it was. I did the thing where I said, hey, this is where I expect it to go. Then the next video I showed you, and yes, it did go into that area. But I also said that I was expecting it to. Actually, I think it was right around this area, if I'm not mistaken, because it had to do with being symmetrical between here and here, right? And I learned this a long time ago, but yesterday I just refreshed my memory on this. So if you use a Fibonacci, and don't use the wicks, just use the bodies, right? Use just the bodies, because the wicks are kind of more of a distraction than anything. What you will get is that you will get, let's say, this measurement here, right? What we call a Fulcrum Point, right? So if we take that and let's see here, measure that to here, right? And then we'll take this and we'll move it straight up. And there. So it's pretty much sitting on top of that same line. So we would expect it to go the opposite way, about the exact same length. And what does it do? In the wick, it does that and just a little bit more. So if you're ever wondering how far these things can go, especially if you're dealing with one of these charts, this is how you can kind of measure it without guessing, because there's really no such thing as getting as close to that exit as what you could there, right? So then once that happened, then it was on to the next one. So next one, this one came down and filled the entire gap fully. So now that it filled the entire gap fully, we can use that, right? And then I think I actually already did the measurement. So the measurement would have been from here up to here. What did it do? Well, it didn't get there at first, but later on it did. Later on, it actually ran right through it. Now, there's a reason why it ran right through it, and I'll get into that in just a second. But at least you can know from now on that if you're ever in a doubt about how far, a trade can go, you can always use the last swing as your measurement toward what your exit is going to be. So now moves up, it goes into the area to where I thought I was going to, stays here for a while, just kind of does a little bit of consolidation, leaves another fair value gap right here behind, pulls down in, fills that up, pulls up, fills it up again, pulls down. So it's almost making sure that these fair value gaps, these imbalances, are now balanced is what the price is doing, right? So then it pulls back up out and then jumps up and gets into that 5-minute fair value gap again. Not only that, but it also hits what we call a bearish order block. So a bearish order block is your last up candle before the next down candle closes below it and starts, almost a down run. So that's when it comes up here, hits that, also enters here, and that is a dead giveaway that it's going to go short, or at least shorter than the previous low. So that's what you would aim for if you were to see that as a trade setup, which I would see that as a trade setup, because I would see that going into the bearish order block, going into the fair value gap. Even though it has been closed in, it's still there. The algorithm still knows that it's there. And then boom, it just goes short. When it goes short, what you do is you aim for the first low. Okay, it stops, and what you can do, you can think it continues to go up, but what it can also do is that you can also aim for the second low too. So that would be this one right here. So you could aim for here, boom, you could tick off 50% of your trade, and then move your stop loss to even, wherever that may be. Once it pulls back up, you can see it trying to get out of this fair value gap that it created. Once it gets to the top of it, right now it's almost as if it doesn't really touch it, but there is another bearish order block, I guess you could say, that starts at this bullish candle. It doesn't necessarily get all the way up to it just yet, but it gets just above the fair value gap and then drops again. And when it drops, it gets below this low. Because why would it try to get below this low? Because that is an area of liquidity. Again, what does price do? It attacks first what we've been talking about, the imbalances. Second, liquidity. So this would be an area to where people would be thinking is safe for support, and they would again do that one thing that I showed you where they would buy. Well, that just went away, didn't it? Yeah, it did. Where they would buy fairly early and then have very, very short stop loss. And what does this thing do? It would probably go through the regular typical retail trader stop loss and basically take them of their money. And then now that it's this low, right, everybody's thinking that it's underneath this point. Okay, I'm gonna sell off. It's underneath that point, and then all of a sudden it goes the other way. It does that on purpose because it wants to make you think that it's going to sell off. So now that it's actually going back up, and it looks like it's basically kind of creating almost equal highs. So what we would call relative equal highs. They're not really equal highs, they're relative equal highs. So they're high enough or close enough in height that, again, this would be considered kind of an area that would be resistance, correct? Right? After leaving, well, let me see here. This doesn't come into play until later, but we'll get into the bullish breaker. But as you can see, it comes down right here. It leaves another fair value gap or imbalance in the trade, right? And look at this. Some of these things are just incredibly almost directly on. So pulls down below. All right, the bodies stay within this old fair value gap that has now been basically filled. So now it's balanced. So now that it's balanced, the bodies stay within. They don't go below. The wicks do go below, right, to try to get people to think that it could be possibly dropping lower. Not really sure what the reasoning is behind these two lows, but they do drop below this first immediate low, right? And then what they do, run up, and this one runs right through that imbalance. So that you have an imbalance going down and imbalance going up. So now it's still imbalanced because it has not actually ran its course, basically, I guess you could say. So this is where the coming down part comes back in. So it comes back down, touches the bottom, runs up, breaches the highs, comes back down, fills it up again, drops below. What does it do? Get back inside this old fair value gap, just barely gets inside of it, but then wicks down really quick and then runs up. So this is all designed to make you think that it's going one way when eventually it starts going another. That is basically how this is all designed to do. And it does that so you start chasing it, and you chase it everywhere. Especially if you're a futures trader. I mean, if you're somebody that's like a down average cost type person, and you're just waiting for lows, good luck, because who knows when the lows are going to be. And then what happened here was interesting, because I actually went to the store and I was kind of upset because I was watching this all day, waiting for this to happen, and then it happens as soon as I go to the store. So it comes up, and you can see it makes this high right here. Oops, didn't mean to move that. Let me move this back. Actually, I want to kind of zoom in on this whole area. Let me throw the ATR down here, and also Williams down. Okay, so you can see you have almost equal high, and then this one comes up, and the whole point of this right here is to make you think that, okay, it's going too short because it is at that resistance level, right? And so it does pull back down, and then it pulls back down, and what does it do? It rebalances with the previous candle. So you know how there's gaps in between candles? Well, there's also rebalancing of them too. So if the candle comes back down and does touch, the wick of the previous candle, that's almost like a green light to start going up, or to actually be, bullish at this point. Or at this point in the chart. Now, what I would be looking for, this limit right here. I would have a limit set right here, because that would be the symmetrical point that we had from earlier, right? And to see if it would get to it. Not only does it get to it, but it blows right through it, all the way up to 35.80 pretty much. Now, there's a reason why it got to 35.80. Institutions like round numbers, all right, and they like specific numbers. The zeros, the twos, the fives, and the eights. Those are the four numbers that they are attracted to, all right? So since we went through and we did this as we were going up, was the 35.50, which right here, 35.50. It was actually at this would have been at the top of the weekly. I think this is the weekly fair value gap, is what I determined earlier. Yeah, top of the weekly fair value gap, 35.50. Once it gets to a round number like that, it has a good possibility of running another 30 to 40 points over it. So what does it do? It runs exactly 30 points above it to 35.80 before it starts to pull back. And it pulls back quick, and it doesn't just hang around there for a little bit and then go on. The reason it pulls back quick is because it makes you think that that you're catching a breakaway, right? Especially once it stops, pulls back, and then starts moving up again. You're thinking you're catching a breakaway. Everybody's buying it at this point, and then smart money takes it right away from you, right? And then pulls back all the way down into here. So I'm going to get rid of this really quick, because that was just for measurement. So this is what I was looking at too whenever I was personally trying to figure out where I was going to enter, and I had these guys marked out because I knew these lows would be here, right? Not only would these lows be here, but that's also within the 15-minute fair value gap, and then below that you have a 5-minute fair value gap. So here's the 5-minute. There's also a 5-minute in here too, but we're not going to worry about that right now. We're just going to worry about the 15 and the 5 that are both on top of each other. and it came down and it touched that 15-minute fair value gap, and it ran up the other way. And as soon as it did that, I wanted to get in the trade, and I wanted to go long. And I stopped myself and I said, no. I said, it's going up too fast. I said, all it did was touch the imbalance. It did not come into the imbalance. I'm going to wait for it to come back down into the imbalance. And I did. So this moved up just a little bit more. And then it started dropping again, and it dropped into the imbalance. So that is where I ultimately got into this trade, when I should have been actually recording this video. I got into this trade here, right? And I waited. I knew there was an imbalance here that it would get up to. Now, what I was worried about was it coming back down into this 5-minute imbalance, but then again, I didn't think it would get any lower than that because we're having such a bullish chart. I didn't think it would get any lower than that. So it comes up, and you can see again the magnet theory comes into, repels, comes into, repels, comes into, repels, and then gets up into, repels, and then boom, right through it. That's what I was waiting for, to shoot through it, because that's what it usually does. We'll usually shoot through it. And then now what? Now we are to another, I think we're at a 15-minute. Oh no, maybe not. Well, it was a previous 15-minute fair value gap. Now we have a very, very long wick. So I don't even know. Technically, that is not considered a fair value gap. But then again, it only ran down through it, and it only wicked through it on this side. So therefore, it's really not balanced yet, because it has not spent the time in the imbalance to balance it, if that makes any sense. I'm pretty sure it does for you guys. So therefore, it comes into the imbalance and back out into the imbalance, back out into the imbalance, back out, and then it drops way down here. And why does it drop way down here? That is a good question. For one, to get people that are scared, well, not scared, but yeah, I guess you could say scared, people that are thinking that they have seen it do this already. They've seen it clear these lows. They're thinking that it could possibly fall. That's why you use the Williams percentage R, because this here tells me the volatility and what type of volatility we're going to have. So even though it dropped, my Williams percentage R, even on a 15-minute time frame, is still at almost oversold and going up. So I'm not worried that it's going to drop, right? So I still think. Now, I did take off about 50% of my trade once it got into about midway into this imbalance. Halfway into imbalances is where I like to take off trades. Or just looking at halfway into any kind of imbalance, any kind of order block, any kind of mitigation block, or anything like that. That's where you like to look at for price reaching to, right? Here we have another one, right? And then here we have a very, very large one. Now that is for the 15-minute. That is not for anything else. I'm sure if we put this side by side for an hour, those two candles touch and there is no imbalance. But considering we are dealing with Ethereum here, I would expect these imbalances to act as magnets. Right? The only thing that I would have to worry about to be bearish would be this bullish candle right here. All right, and the only reason I would worry about that one being bearish is because if you put some kind of line going all the way across from the body, that would be considered your bearish order block. So once it reaches through this imbalance, it could hit this bearish order block, retrace. Now it could retrace back into the fair value gap, and it could spike through the bottom. But I have a feeling that since we are already in this imbalance as we have been before, that the bodies are going to respect being inside this imbalance, and then after that it will eventually run up. So that's what I'm thinking is going to happen to Ethereum, and eventually maybe above these highs, 35.80. That would be a price that we have not seen in quite some time. And actually, let me go back and see, just for the fun of it. Let me get on a different time frame here. Okay, so yeah, this whole red box here, this is a fair value gap of the weekly. So it's a weekly imbalance fair value gap. Here is a daily imbalance. So there's an overlap, almost like a Venn diagram overlap happening right here. That price actually went within before being kicked back out. And let me move this 5-minute gap thing because that's over with now. Now what I'm doing right now is looking at the 4-hour, right? So this happened a couple days ago, this low right here. This low happened a couple days ago. Came back down into this fair value gap. As you can see, this is a 4-hour fair value gap. Dropped down into this one almost about halfway before it takes off. Now, the thing is that we have another one of those. So even though we've been using the 5-minute, the 15-minute fair value gaps, don't forget there are larger time frames to be wary about as well. Look at this. This is one of them. Now this one I'm actually going to pull in because it looks like we've gotten about halfway into it, and then that is what took us up and over this high right here. And we have almost touched this high right here. There's a very good possibility that we could see it come back down into this area. Actually, I think there's a huge possibility we could see it come back down to this area. Why? Because this is where your premium is. No, your premium, your discount is. Your discount is, of course, your price that is going to be below 61.8%. That's what smart money looks for. Okay. So that's what I think we could be looking for as far as Ethereum is concerned. Right now, I do still have a long on it, though. I'm not going to lie. And I'm still in the green, so I'm okay. But the thing is that the only reason I still have a long is because we did hit that very, very huge high, and we could still be seeing it trying to get into those blocks that I put in. As you can see, there they are right there. We could see it trying to get up into here now. Why would that matter? Well, because if you actually flip the Fibonacci the opposite way, that's at a premium. That's at a premium price. So you would want to sell at a premium and then buy at a discount, right? So if it got all the way up here, that's a pretty high premium. And also entering an imbalance. So there's two birds with one stone. It wants to cover that imbalance. It's got that imbalance. Boom, it drops. Where does it drop to? It drops to the premium and also an imbalance. Then after that, it could possibly move up. And that's when we might see the actual daily get filled. So that's just a huge rundown of what has happened with Ethereum, especially today and recently. As far as the week is concerned, this is one of the things I wanted to look at, was almost every single one of these weeklies. But I know I don't want to bore you all with your time. But we can see we had a really good green week. We ended as I predicted. If you watched any of my content, especially my Christmas content, that I said March would be the month that we turn around. And actually, I mean, look at April. April, we're already moving up too. But it was also February. Well, February for some, not so much for others. But March, I think we all had a green candle. So that's one thing. And that's one thing I was also worried about on Thursday. What was it? I think whatever day the 31st was. I thought we were gonna have I thought we were gonna happen. What happened today happened on that day, the last day of the month. Have a huge run up and then a huge drop down to be the wick of the month. But instead, we already had a big wick of the month. Instead, what we created today was the wick of the week. So just keep that in mind when it comes to high time frame analysis. Always think about things like that. Your wicks forming, when do they form, how do they form, things like that, because there are weekly profiles, there are monthly profiles that the algorithm does kind of adhere to, right? Such as if it's going to be a bullish week. Well, if it's going to be a bullish week, you kind of usually have an uptick on Sunday, Monday, and then generally it'll drop Tuesday, Wednesday, maybe get its low point on Tuesday, maybe its low point on Wednesday. Just depends on what's in the chart. And then moving on, Thursday, Friday, Saturday, it continues moving up, all the way up, and generally up until Sunday. And then once Sunday hits, it'll start giving a pullback. Why? To give that top of the wick. Or it could do that on Thursday, actually. It could do that on Thursday, skyrocket way up high and give a huge wick and then consolidate for a little bit. I've seen that happen too. So just little things in here and there that I just want to implant in your brain to make you start thinking outside of the box. Not so much like retail, not so much like thinking, oh, there's double highs, oh, this thing is doing a crab, or this thing has a bear flag, or this is along this trend line. None of that stuff. Price does not know if it's doing any of that. Okay, so price remembers levels, right? It remembers price levels, and it remembers them by time, right? So that's why the time element is such a huge thing too. So that's why a 1 hour time frame and a 4 hour time frame can be two different things, but price remembers, if it, once 1 o'clock hit or something like that, wherever that low was, it remembers that, and maybe it has to come back down to that at that time 12 hours later. I don't know. But the algorithm does know these things. So, that being said, let's move on. It doesn't really touch it.